Okay, so we've discussed the first market internal, known as the advanced decline line. Now let's get into the second one, known as the NYSE tick. Now the NYSE tick, later on in the training, once we get into tactics, strategy and tactics, will have some uses for getting you into trades at good entry points, but it also allows you to see the health of a market during the day and lets you again look under the hood to see what the stocks that comprise the index are doing, in this case on a very short-term basis. So let's get into the chart and see what it's all about. Okay, here we are looking at a chart of the NYSE tick indicator. Now, if you haven't seen one of these charts, you're probably thinking, what the hell is this? And that's okay. It looks chaotic. It looks like something a doctor would be looking at a screen, gauging some patient's heartbeat. But once we explain what it's all about, it'll be much easier to understand. So let's do that. The NYSE tick measures the number of stocks in the New York Stock Exchange that are currently trading on an uptick minus the number of stocks trading on a downtick. Meaning that right now, at any given moment in time, right, how many stocks are being bought and how many are being sold in this moment. This is not like the advanced decline line, which compares them if they're up on the day versus yesterday. This is someone buying the offer on the stock, in which case it's an uptick, or is someone selling the bid, on which case it's a downtick. So this really shows you the buying and selling pressure on a moment-to-moment basis throughout the day. It's updated once every few seconds, so it's a very short-term intraday indicator that looks beneath the hood to see the buying or selling pressure on the stocks in the New York Stock Exchange. So, for example, taking a look at this candle right here that's sticking up, all right? At this point, if you'll see, this line is 800, right? So this is slightly below it. It's around 750. So at this given moment in time, there was 750 more stocks being bought on the offer than there were being sold on the bid. And if you look down here, for instance, here there is 500 more stocks being sold on the bid versus those being bought on the offer. So there's the zero line. When it's above zero, more stocks are being bought in that moment. When it's below zero, more stocks are being sold in that moment. Now the NYSE tick is a very interesting indicator that has multiple uses for deciphering price action. One use it has is telling us when the market has hit a sentiment extreme. Now what does this mean? Like we had talked about very early on in the training, market behavior is influenced by the emotion of human beings. The moment-to-moment buying and selling pressure often shows that emotion right here on the chart through the NYSE tick. Let me give you an example of that. Okay, here I've overlaid the NYSE tick chart over top of the S&P 500 price chart. And take a look at what was happening here. The market opened up on this day, drove up higher, and then had a big bar, just shot up and expanded higher very quickly. Now look at what was happening with the NYSE tick at the same time. It shot to over 1,000. At this point in time, over 1,000 stocks more were being bought than there were being sold. While this is a good thing overall, on a short-term basis, these often show signs of exhaustion. And as we see, the market had to rest and pull back a bit, about 2 or 3 points, after this very short-term exhaustion. This is a point that was showing a sentiment extreme for this small time frame. It was showing a buying extreme. The market got a little too bullish too fast and had to rest right away after that. And then if you'll notice the other extremes, let's say here, right, when the market shot up again higher pretty quickly, hit an extreme in the tick, and then it pulled back, right? Here, there was a big shot up, extreme in the tick, and then pull back. Again, this does not mean that every time we hit an extreme in the tick, this is a great selling point. For instance, look at here. This was pretty much similar extreme, but we barely did anything. So this is not straightforward. It's not like that. Again, later, we are going to show you how to put it all in context, which is what really matters. But now I'm explaining the basics behind it. And so that's one of the basics, that it shows you sentiment extremes in the market. The other way to look at the NYSE tick is to look at the tilt or the slope of the tick above or below the zero line. All right? For instance, this is the zero line for this market day. If you look at it, tick is shifted overall above the zero line, mostly. Now, of course, there's a lot of times it goes below zero, but the question is, where does it spend the majority of its time, and where are the extremes? The deepest extreme here is minus 600, minus 700. Most of them stay above minus 400, right? Whereas here, we get up to plus 1000. A lot of them are above plus 400, and the majority are centered around the positive side of zero versus the negative side. It's as if we took the whole chart and shifted it up above zero. Just looking at this without even seeing a price chart should tell you that you're probably having some nice upward movement during the day. Now let's take a look at another day. For instance, this day. Now this day was completely range bound. It was a complete balance day. It did nothing. It was up and down, sideways the whole day within a very tiny 5-point range. Now let's take a look at the NYSE tick. You'll see that the NYSE tick was quite balanced above and below zero. It would have times where it stretched quite a bit below and times when it goes above. There is no real tilt or shift to it. And the other important thing is that there was very few extremes. There was only one minus 800 reading here at this one push down, and that's it. All the other ones are at most reach about plus 600, plus 700. Here it reaches minus 700, minus 500. So what that's showing is that there was never a time in this day, except for these very little instances, where one side or the other took control, where either the sellers took control momentarily or the buyers really took control. And just by looking at this, you should be able to gauge that it was a range bound or balancing day, because balancing days are characterized by the very fact that neither side really takes control. Neither side has the conviction. When they do, you would see very extreme readings in tick. That's showing the momentary buying or selling conviction. Here's another day that was opened higher but trended down all day long. And if we look at the tick and where it's shifted on the chart, it's more below the zero line than it is above it. And we see that it was consistently hitting minus 800 here several times, here, and then it even hit a minus 1200 major selling extreme here. But because it was a downtrend day, right, that major selling extreme only caused a bit of a bounce, and then we even hit lower lows. So this indicator has many uses, but it's also a subtle one. It takes a lot of experience in watching it and reading it to be able to tell how it works. I can give you a few rules of thumb to help you better decipher it, to guide you in your learning process of understanding the tick. And of course, they all have to do with context. One of them, for instance, is that in range-bound market, in balancing markets, if we do hit a major extreme tick, that can often be the point where that move, that short-term move, ends, is no longer sustainable. Whereas the second maybe rule of thumb is that in trending markets, if the market has been trending, the extreme ticks only really confirm the directional conviction and maybe will cause just a temporary pause before price keeps going in that direction. Those are very broad, but they're helpful for helping you keep things in context. The day type will affect how you interpret the tick. If you're noticing a sideways day, those tick extremes are more likely to serve as the end of certain extreme movements, whereas on trending days you're just going to keep seeing extreme after extreme. But again, it helps you confirm what you're seeing on the price chart. For instance, if you start seeing a downtrending move, but you're not really seeing a lot of negative tick, that should tell you something. Maybe you shouldn't trust this down move. For instance, that's one way to read it. Another way to gauge it is if let's say you're seeing a down move again, but on the retracements, on the pullbacks, you see really positive tick. Well, that's not very normal for a downtrend, so that might make you question if this is actually going to turn into a downtrend. In a real downtrend, in a strong downtrend for instance, the pullbacks will usually end on a slightly positive NYSE tick, let's say plus 600 or even sometimes plus 500, 400. Those will be the extremes of the pullbacks on a strong downtrend. Same with a strong uptrend, minus 400, but it won't get really deep, right? Because the selling pressure, for instance, won't be there on an uptrend. The pullback will have shallow ticks. But if you're seeing the pullbacks have minus 800, minus 900 or more, be wary that this might not be an uptrend, right? So this gives you a deeper look into character of movements. Once you start studying the tick and how it usually behaves, and it'll take a while because it's such a subtle indicator, but using some of these general principles, you'll understand what's usually the character of certain types of moves. And when you see the tick displaying a different type of character, that can be a heads up that the move you're seeing isn't for real. I.e., let's say a downtrend might not be for real if every time we bounce we put in really positive ticks, but on the downside we're not really putting in negative ticks. That might be just a temporary down move that's going to reverse. Now, of course, it's all contextual, but these things help. And so that in general is the tick indicator, our second market internal that we employ. And now in the next session we're going to take a look how we use these market internals in context to give us a deeper understanding of intraday behavior, to allow us to combine them with key reference areas, with price action, to better decipher market behavior, to better be able to time the market, and to better be able to judge the character of any given day. And the character of a day really determines what day type it's going to be. So all these things fit together. And when you're trading the stock index futures, or you're using them to trade stocks, these things can be very invaluable in getting a deeper look.